Hey everybody, this is RC Peck, and this is my 30-day forecast. And this is where I sit down and deconstruct the stock, bond, housing, currency, and commodity sectors by looking at their price charts. So as a reminder, what I'm going to do, or the order I'm going to do it, is I'm going to first look into those sectors and look at the price charts and just kind of tell you what I'm seeing, both the positive and the negative. And then at the very end of that sector review, I'm going to give you my main takeaways so you can have the one thing to take away from each group. So with that, I want to start with the stock market. So I want to jump over to the price chart of the S&P 500. And on the screen here, you see the S&P 500. You see a red line. That is the 200-day exponential moving average. And you can see that it took a sharp turn right here near the middle to end of August and has been falling now. All things being equal, if you want something to go up, you probably don't want the 200-day moving average to be falling, and it is falling now and has been falling for about 6 weeks now. So that is negative. The stock market clearly moved down. In 6 days, it moved down 11 percentage points, which is pretty incredible. But what I'm noticing is it's having a lot of resistance at this horizontal line that I put in, which was a line that I've talked about many months over the last year, because this is what's called a false breakout. It came back down and finally broke above it, and then it's sitting on top of it. So the positives, the market has not broken down below this line here, the August low, which is also the October low. So that is a positive. The negatives, as soon as it gets up to this line, there's people coming in and selling their positions. And then what you have, of course, is this line up here, which is another line of resistance or another ceiling where if it does get up there, now you're having it move up against the 200-day moving average and this other area of resistance where there'll be a lot more people coming in to sell their positions. So right now, I would say there's probably more negativeness on the S&P 500 than positive. It's not neutral. Short term, really short term, the market's deciding what to do. But if I zoom out and look at this on a longer period, the market's been going sideways for a year. It has broken down below that line, and it's now deciding, should I continue down? And the next place it would want to go is that October low, which isn't showing up here, but it would be the October low. And then you have the 200-week moving average. But I think the real place that the market wants to move, if it does keep moving down, is this line right here, which is the 2007 high and the 2000 high, which is generally speaking about 1585. So from the peak to the fall here, that's about a 25%-ish drop. And look, a 25% drop is not that big, especially if you consider going back to the bottom of 2009 to where the market peaked in May. Market's up 215%. So if there was a 25% drop after going up for 6 years, 215%, that's well within line of a healthy correction. So as far as the health and state of the market, it's still healthy, and corrections are part of being a healthy market. Let me quickly show you the international market, looking at the ticker symbol EFA. You can see here when you look at it, it's looking much worse. This 200-day moving average has been falling, going up, falling, so it's been more sideways. And you can see that here the international market's actually below its October low, and it hit another low in January. So international is doing much worse right now than domestic. Though at the beginning of the year, the first 5 months, it was absolutely beating the S&P 500. And then lastly, I'll just show you Europe. Europe looks very similar to international, which makes sense because Europe is the largest economic bloc on the planet. So it would make sense that it's looking very similar, though still not good. So that is the review of major markets. Again, the main one I review is the S&P. The takeaway from that is, and I'll go back to the S&P, is it's really deciding. It's really in a decision-making situation. Should it move higher? Should it move lower? Now, I will say there's a very high chance it's going to come down here and test this August and it's October from 2014 low. So that seems almost like a shoo-in. The only reason that would not happen is if a central bank came out and just made some absolutely incredible announcement, or maybe Yellen comes out and says we're going to do negative interest rates, or we're not raising rates for 5 years. But I think something pretty significant has to come out of the mouth of a central banker in order to move this higher, because, man, every time this moves up, or at least these times, it's getting hit with a lot of selling. And it's very likely that we'll come down here and test these August lows. And it's when we come down and test those that we're really going to see and really figure out what's going on. And it would not make sense to me, though no one calls me and asks for my opinion, why a major central bank would do anything until this August low is even being tested. Because as of right now, this fall, or where the market is right now from its high, is not that big of a fall. I mean, look at this, just where it is today, 9%. 9% ain't no big deal. But one of the biggest central banks in the world is China, and their price charts look much worse. Their fall, I'm using FXI, but if I do this drop here, that's a 36% drop. And if I go over to the very end date, just move it right over there, that's a 32% drop. So that, China's in a little different situation than us. And one thing I've said in the past about China is none of those politicians, none of the people that run the government of China have been elected. And this is why over the last 5,000 years, certainly the last 65 years, you've seen a lot of grassroots issues and problems in China because no one gets to vote for who is leading them. So I'm sure the Chinese leaders are scrambling to figure out how to keep the masses in line. Now, I want to do one more thing. I want to look at the sectors that make up the S&P. Just do a quick look at them. This is the financial sector. Again, it's got to stay above that line. If it breaks below, that's not a good sign for the financial sector. This is the utilities sector. If I zoom out, this kind of looks like a shoulder here and a head here and a shoulder here. So that could potentially be a big head and shoulders, which is not a good sign if it breaks below. And the majority of the movement or the fall always happens below the neckline. So that is utilities. This right here is consumer staples. It's actually not looking that bad. It's looking okay, but again, this is what's called a rising wedge, and that's usually a topping formation. This right here is consumer discretionary, which is pretty amazing that this is basically everything consumers buy that they don't need. And it's sitting above its 200-day moving average. And it's probably the best looking sector in the S&P 500. So if there was any positive coming out of what's going on right now, it's that the one sector that's usually the most sensitive to downturns, which is how people spend their money discretionarily. Can't really say that word. Discretionarily. It's actually holding up the best out of all the sectors. This is the S&P. Here's the technology sector. Again, not bad looking. It's got to stay above its August and October low. Here is the industrial sector, looking really bad. If you look here, this August low is below its October of last year low. So this industrial sector is looking, it's one of the worst sectors in the S&P, though it can always get worse, and it does. You have the energy sector, which is just a disaster right now. And man, it's looking for a place to bottom. It doesn't know where to bottom. Some of the major stocks within this, like Chevron, let me just show you Chevron quickly. Here's Chevron right here. If I zoom out, you can see that Chevron is way down here. It's getting close to its 2010 and even its 2009 lows. And then you have Royal Dutch Shell, which is another huge major player. And look at this thing. It's almost a shoo-in to go down and hit its 2009 low. I mean, that is amazing. And then you have British Petroleum. Man, this looks like for sure it's going down to its 2010. Now, remember, this is when it had its Gulf explosion and it absolutely plummeted. This looks like it's for sure going to come down here and test it again. So XLE is in really bad shape. That's the energy sector. I'm not sure how the market can move higher when one of its major sectors is absolutely plummeting lower. And this is all on the back of two things. Well, really one thing, but I'll get to that in a second. Lower energy prices. One of the reasons why there's lower energy prices is because over the last 6 years, borrowing money has been free. So what you see on the screen here is a result of the central bank of the United States saying, hey, we're going to print a lot of money, but even more importantly, we're going to drop interest rates to zero. So what happened? $500 billion of borrowing went into the energy sector, and it worked. We're getting super, super cheap oil and natural gas and other liquefied and liquid energies. So, long term, it's probably going to be a good thing that they did that, and that the tens and hundreds of billions of dollars that went into research and technology for sideways drilling and fracture drilling, fracking, is going to turn out to help the U.S. very long term. The U.S. is such a unique country because it has pretty much safe borders, 2 oceans, Canada to the north, and then Mexico to the south, which it can handle. It's nothing like Europe where they're having millions of people walking into their continent wanting help, needing help, and they're the poorest of the poor in that part of the world. So the U.S. is in pretty good shape, but man, energy, it's going lower. I don't know where it's going to bottom, but once Iran comes on, and maybe that's already priced into the oil market, it looks like oil and energy is heading even lower. Here you have, let me zoom out. This is the materials market. I don't, do I need to say a lot here? It's looking horrible. It's way below its August low. It's way below its October low of last year. And I had it zoomed out here. You can see this thing. It's in a free fall, and it's falling. And the last sector is healthcare. This includes medical devices, biotech. And look, just like, actually, this is not true. This has been a much, much stronger sector than any other sector. The healthcare sector and the discretionary consumer sector have been the 2 strongest sectors in the S&P over the last 3 to 4 years. And you can even see here the October low is way down here, but like everything else, it's got to stay above its August low. And if not, healthcare can move all the way back down to 60 and test that. So the big takeaway from the stock market, the 2 best sectors right now, if you can call it, I guess you could say it's best based on relativeness, but I would say the best sector right now is actually consumer discretionary. That's the best sector right now, and it's holding up the best. The big takeaway from the S&P, it absolutely has to stay above. Let me move it over. It absolutely has to stay above the August low, and it pretty much looks like it's going to test its August low. Okay, the next thing I want to do is I want to look at bonds. So let's see. Let me jump to a couple bonds here. The first bond I want to pull up is just long-term government bonds, just having you look at this. You know what? It's going sideways. When the price on this goes higher, right? That means people are paying more for it. That part's obvious on this price chart. But that means the yield on the 30-year Treasury or long-dated bonds in the U.S. are going lower. So right now, what's so interesting to me is with the market pretty dramatic crash, that 11% in 6 days. What surprised me most is that this did not scream higher. It actually fell, which to me was pretty amazing that this fell. And my final conclusion was when people were panicking into long-term U.S. government bonds, China was on the other side selling hundreds of billions of dollars of their reserves into the market. So usually you would have seen this move much higher because people moved to safety. And you can even see it too these are kind of the belly of the bond curve, the 7 to 10 year duration for government bonds. And again, this did not scream higher either. It actually moved down. So very interesting when we have these huge players on the playing field like China with trillions of dollars of reserves, the majority of it in U.S. government bonds. We're not going to necessarily see the same canaries in the coal mine that tell us what's going on. The biggest takeaway from bonds has been municipal bonds. Municipal bonds have held up well. Here's a municipal bond. It's one of the largest ETFs for municipal bonds, MUB, just as far as size goes. And it's held up pretty well. VKQ is another municipal bond. It took the hit, but not much of a hit. It's kind of recovered. What I like about VKQ, it's kind of deciding what to do. Corporate bonds right here, still kind of deciding what to do. This was the big correction here for the stock market, so people didn't really rush into corporate bonds. If I zoom out and show you a what's called a weekly chart back to 2009, you can see that there's some upward support here coming in, but it's hitting up against its 200-week moving average. So not a lot of information coming out of the bond market. And part of the reason I think this is because the demographics in the U.S. are changing. We have 78 million baby boomers. They're going to be spending less. They're coming out of the job market. They're coming out of the workforce. Things they do spend are going to be more on staples. But what's interesting is they're in stocks more like the Dow Jones, right? So they're in kind of the bigger mega cap stocks. And what I've noticed is the Dow Jones has greatly underperformed the S&P 500. Now, the Dow Jones Industrial Average only has 30 stocks, 30 very huge stocks, but the S&P has 500 stocks. So it's really interesting. Usually, those bigger ones are safer, but my take on this is that the people who own the bigger ones are getting scared, and so like, look, just get me my money. I can't do another 2008. I can't do another 2000. Like I made it. I made my money back twice already. I can't. I'm older now. I can't survive another 50% correction. So, in fact, it's the people in some of the larger companies in the world who are taking their money, and maybe they're just putting them to cash right now. They're not even doing the bond thing. Just like, look, I just need the cash. One more thing is I just want to show you the junk bond market. It is looking horrible. Now, this impacts the stock market, and junk bonds act more like stocks than they do bonds. It has about a 6% yield, but notice it is broken below its August low, and it's broken below its December low, and it's broken below its October low. This thing is heading lower. Let me zoom out. It is heading lower. I can actually even get rid of this line right here, and it's going back to retest the panic lows of 2011, and it looks like it's almost a shoo-in to do that. So this gives me a lot of pause on what's going on in the market, because oftentimes the junk bond market is a leader in direction of what the market's going to do, and it is not looking good right now. It's looking like it's going to go test its 2011 lows. So we're going to watch. I'm going to watch to see. I mean, look, it's 2% away from that, to see what happens when it hits that. We could get a little bit of a rally off that because it's moved so far so fast. Well, it's moved so far away from its 200-day that we could see a little rally in the other direction. But it is clear that the junk bond market is in a downtrend, and that is not good for the overall stock market. The biggest takeaway from the bond section, what is the biggest takeaway? It is super, super, super cheap to borrow money today. Like really cheap. Like this is probably going to be some of the lowest borrowing you'll ever do in your life. If your house is paid off, you may want to think about pulling some of it out and buying a municipal bond. You don't pay federal taxes on a municipal bond. You can find many, many municipal bonds that are paying 6%, or many municipal bond ETFs that are paying 6%. You do not pay federal taxes on that. If you take that into account, it's the same net of taxes equivalent of making around 9%. Not bad, especially if you can borrow money out of your house for 3% or 2% net of taxes. So borrowing is the cheapest it's ever been. I've been telling my private clients since 2012, so 3 years and 3 months now, borrow money out of your house and buy investment properties. This is the time to do it. So the takeaway, I guess there's two takeaways. One, borrowing is incredibly cheap. That's one. Number two, the junk bond market is absolutely screaming, something is wrong. Guys, something is wrong. Okay, next I want to jump over to housing. Housing's usually straightforward. I look at ITB here. This is a closed-end fund, an ETF, a basket of stocks that are filled with companies that build residential housing and help people who own residential housing keep their houses looking nice. And this thing is looking amazing. I mean, if there is one subsector, this is a subsector. It's not a main sector, the 9 main sectors that add to the S&P. But this sector, it's probably one of the best looking sectors in the S&P 500, if not the best looking sector. So if you're looking for the best looking sector in the S&P 500, you are staring at it right now. And it is holding up incredibly well, like incredibly well. Staying above its 200-day moving average, and is just going sideways while everything else has broken down. So this talks as much to what's going on in the bond market and what happened from 2007 to 2012 when people just stopped buying houses. There's pent-up demand. People want to get into houses. Yes, people still have money, but man, the best-looking sector right now in the entire S&P 500. So that's what we have. I'll do one more price chart for housing, and this is the 10-year yield. The yield on the 10-year Treasury, which is the closest yield bond. It's the closest bond to influencing mortgage rates. And if I zoom out, you can just see here. Look, this is a weekly chart. We're looking at this price chart going back to 2009. You can see the red line, which is the 200-week moving average. It's still moving lower. Now, we had a crazy low in 2012. We had a very good low in the beginning of this year, 2015. And the general trend is still down. I mean, I can zoom way out and show you that the trend is still down. So the momentum and direction and path of least resistance for mortgage rates in this country is still lower. And that's part of the reason why ITB is looking so well. And if I zoom out on ITB, I just show you, it went sideways in 2013 and 2014, broke above that. It's just hanging out up there, just hanging out, just kind of waiting, biding its time, and not breaking down. That is super, super impressive. Okay, I got two. Oh, so the takeaway, great time. What is the takeaway? Best looking sector in the market. Rates are going lower. Good time to buy investment properties. Good time to buy housing. Okay, I want to look at currencies. And I want to look at currencies on a different screen. So let me actually pull this up. And you know what? Let me wait on that. I may come back to the screen, but let me just pull up some currencies here. Here's the euro right here. Second biggest currency, fiat-based currency on the planet. And it's kind of flirting, if I zoom out, from a technical point of view, this movement right here is actually a bearish looking chart formation where you have this big fall down and then what's called a flag. It kind of comes up on an angle and then falls again. So from a weekly, this is a bearish chart formation. And look, the European Union needs the euro to be as cheap as possible to help that country and that continent because it's not in good shape. Its unemployment is double of what the U.S. is. It's in much worse shape. There's many countries that need to debase their currency, but they can't now because they're all on the same currency. So it's going to, the European problems, and now you've got this millions of people coming in from the Middle East. And so there's huge strains happening in Europe right now. One of them being their currency and being on the same currency. Another being this flood of, do you call them immigrants? Do you call them refugees? I don't know. I don't know what the specific word is to use, but millions of people are wanting to come in, and there's no oceans to hold them back, and there's no Canada to hold them back. So anyone who thinks the U.S. has issues with people migrating from our southern border, we ain't got no problem compared to what Europe's got going on. And I'm not laughing out of it's funny, but it's the U.S. is pretty well situated. Okay, the yen is bottomed. The yen is bottomed. Now, has it bottomed? Like it's not going to go any lower? It has been going sideways for 10 months. after it made a very huge fall, peaking in 2011 and falling. And that's kind of helped the Japanese stock market. But the question now is the yen, is the Japanese government going to take another leg down? I mean, look at that fall, 40%. They destroyed their currency 40% over 1, 2, 3, 4 years-ish to help their economy. They still don't have inflation, by the way, everyone. And you might be saying, what's their stock market look like? It looks all right if we compare it to using it the same thing, looking at the same type of chart that we did with the other sectors and the US and international and Europe. You can see it's already broken below its August low here, and you got this kind of this double bottom between October and January. So though it is up kind of big today, the direction of it is still down. I will say if the Japanese yen does break above, that's probably really bad for stocks, but could possibly be really good for gold. And then last, actually, let me just bring up this. I'll just bring up the US dollar here. Zoom way out. Couple things here. Silver bottomed here in May of 2011, and gold bottomed here in September of 2011. So as gold was falling in 2012 and in 2013 and halfway through 2014, the dollar was going sideways. So this idea that gold always moves in the opposite direction of the dollar is actually not true. And then the dollar took off, and it's digesting this huge move right now. If I zoom out more, basically it's just digesting this move. Now I'm looking at a monthly price chart here going back to 1991, and this is also this chart formation here is called a flag, where you have this flagpole here, and this is the flag. And even though it's dipping lower, that's a very bullish formation. Now, of course, I don't know which direction the dollar is going to go, but as far as this one time frame, it's a bullish formation. I'll say one thing about the Chinese yuan. It is pegged to the US dollar. So when the dollar fell from 2002 to 2008, it kind of got a free ride, and its products all over the world were just exporting deflation. And so now that it's been moving sideways and the dollar has been moving up, which it's still pegged to, I think this is the reason why other central banks have gotten mad at China, because they're like, hey, look, you got your 40% drop already. You can't drop it again. It's not your turn. It's the Japanese's turn and maybe Europeans' turn, but it's not your turn right now. So the big takeaway from currencies, all fiat currencies are manipulated. All of them are. All currencies are investments. So wherever you live in the world, whatever you are paid in, dollars, yuans, euros, or yens, as soon as you get paid, your money is fully invested in an asset class called currencies. And long term, currencies fall 1% a year. Internationally, domestically, well, I mean, there's two ways to measure currencies, how they fall internationally and how they fall domestically. The way you measure domestic is you measure the inflation rate. So in the U.S., currencies fall about 3% a year on average. Internationally, it's a little bit lower. So currencies long-term fall. Okay, we have the last section. I kept gold for last. I kind of want to do a deep dive on gold. I want to pull up GLD first. Actually, you know what I want to do? Let me go to these other charts, because I want to do a deep dive on gold, and I want to move over to my gold charts. So let me do that. Let me just find them here. And I want you to do your best. I'm going to show you what to look at on this price chart, because I know it looks like about 7 people's heartbeat going up and down. But right now, this is what I'm just showing you. What I'm showing you here is the premium that people are paying, or the discount people are paying for gold and silver. So this ticker symbol, this main box I'm looking at here, the main one, is the premium or discount people are paying for the ticker symbol, the closed-end fund CEF. And right now, people are paying a discount of 9.6% for gold and silver. That discount hit a low of 12% in August and July, and it hit a low of 13% in December of last year. So Again, all things being equal, yes, it's going up, but people are still paying a discount for gold and silver. So one takeaway is if you want to buy some gold and silver, one of the best ways to do it is one of these closed-end funds, because literally you can get $10 of silver for 91 cents. That's not bad. So that's the first thing I want to show you. The second thing I want to show you is something called the bullish percentage index. And this is just looking at the precious metal mining stocks. I know the screen's not big here, but when it bottoms down here, that means none of the stocks in this index are moving higher. And so this thing is still bumping along the bottom. Again, that's not a good sign. That's saying the majority of all the stocks in the gold mining index are falling. That's not good. I'm going to skip that one. That's too confusing to describe. I do want to go to this one. This is comparing the gold bug index to the S&P 500. So the gold bug index to gold. So if gold was in a bullish move and moving higher, you would want to see this price chart moving up, meaning you want to start seeing the precious metal mining stocks moving up higher and faster than gold. But the fact is they're actually falling faster than gold is falling. And I have two moving averages on here, a 70, which is the blue, and the 161, which is the red. But even if I didn't have those on here, you don't want this price chart falling if you want gold to go higher. Again, this is comparing gold mining stocks against the metal itself. This price chart is comparing gold mining shares, or the gold mining sector, against the S&P 500. Again, in a bull market, this price chart would be going the opposite direction. So as the price falls, that means precious metal mining stocks are falling harder than the overall market. So if you're going to be bullish, you want to see this price chart going from lower left to upper right, which it's not. Now, this is the only chart that is actually in a bullish kind of formation right now, and this is comparing small cap mining, precious metal mining shares in relationship to large cap. And so when you see this going higher, that is good, because that means the small cap stocks are moving up much faster, relatively speaking, to large cap stocks. But one of the problems, I think, is the large cap stocks are just falling so much, and the small cap stocks have already been hit 90%, that this may not be the most accurate thing right now. And plus, this is the only kind of index of all the gold things I look at that is really trending higher. This is the last one I'm going to show you, then I'll move back to the other price charts. This is comparing the price of silver to the price of gold. All things being equal, you want to see the price of silver moving up faster than the price of gold. And that means you want to see this price chart moving from lower left to upper right, from down here to up here, and that is not happening. So a lot of the things we want to see in the gold complex to say, yes, we're in a bull market, they have not happened. Now, look, have we bottomed? I don't know. Nobody knows yet. This is a price chart. Let me just zoom out a little bit. This is a price chart of GLD, the Exchange Traded Fund GLD, and you can see the 200-day moving average. It's falling, and it's clearly falling. Like, it's stable. It's in a stable downfall. And you see kind of this battle going on right here with this horizontal line. It was a floor, couldn't go below it, was a floor, couldn't go below it, and then it tried to get above it, and it couldn't, and it's trying to get above it again. So there's a little battle going on right now with this. What I do want to show you is GDX, and zoom way out on GDX. GDX has been around since 2006. It's below its 2008 low, and it's hanging out below its 2008 low. Again, all things being equal, you don't really want it hanging out that low. If I go back to my other price chart and I just put in XAU, because I just want to show you. Oops. Nope. Let me bring it up, and let me bring up a nice pretty chart. This is a weekly price chart, so this price chart goes back to the beginning or mid of 1995. And this is looking at the precious metal mining sector. That's its 2008 low, okay? But here's its 2000 low down here at 42. And right now it's at 47. So does it have to go back to 42? Of course not. But the way that humans work and what we're looking at here is millions of free-thinking humans and how they invest their money and what they buy and what they sell. It's a very high likelihood and probability that this price chart will test its 2000 low of 42 points. Because this is an index. It's 42 points, not $42. And we're only at 47 now. So from something at 47 to drop to 42 after it used to be at 230, it seems more likely than not that it will. So we've got that in front of it. The last thing I want to show you for gold, and we're in the commodities section of this conversation, is just looking at the actual price of gold. And right now the price of gold is about $1,150. One of the things that stands out the most on this price chart to me is this line right here, the $1,000 mark, when gold went from a 3-figure number to a 4-figure number. And as your brain looks at this, your brain can tell from the end of 2011, which is right there, that gold's been in a downtrend. Now, does it have to go to 1,000? Of course not. But it's only like 12% away from that, right? In the big picture, that's actually not that far away. So gold's direction is still down. It may be looking for a intermediate bottom. It may have found one, but in no large position, it has not bottomed and the trend is still lower. As far as other commodities, actually, it's probably easier for me to just stick on here. Other commodities. The other commodity I just wanted to show you was West Texas Intermediate, was oil. And oil took a huge fall of 60% from July of last year to a couple weeks ago. And if you look on the screen here, you can see we're getting down to our 2008-2009 lows of about $37. And the reason why this $34 to $37 range is important, one, you had a double bottom here in 2008 and 2009. But back here in 2000, we hit that number again. And back here in 2003 and back here in 2000, we hit it again. So there's this range right about here between $34 and $37 where, to me, it really feels like oil wants to go test it again. And the trend is down. Yes, there may be some counter trend rallies, but the trend is still down for oil and energy. And again, with that $500 billion of borrowing that came into the energy sector in the United States, there's a lot of cheap energy that's coming out and that will continue to come out because technology is still improving in the drilling well business. So we still have, this is the largest commodity traded on the planet. So we still have some figuring out to do, and it looks like its path of least resistance is down. I'll do one more commodity, which is the second most traded commodity in the world, which is coffee. We added coffee last year, and there turned out to be a really good play. But here coffee is today down here. There's a lot of support of coffee, about 18% below where coffee is today. Again, we're looking at a really big chart going back to 1995. But it could be, if coffee does get down to like this 1.03 metric, that could be a potential good buying part. Buying part, buying position, buying time, place to think about adding to it. Commodities are in downtrend. People are paying less and less for commodities. Is it because they don't need as many of them? Is it because of Janet Yellen and Ben Bernanke lowering rates to zero and people borrowing hundreds of billions of dollars, and that's driving the price of oil down, and that's deflation? And we've got some huge deflationary pressures going on the planet right now. And it's basically three things on the planet that is creating deflation. One, zero interest rate policies across the world, which has made energy super cheap. That's number one. Number two, countries wanting to devalue their currency so they can export more. That's deflationary. I said devalue before, but low energy prices is deflationary. Cheaper currencies is deflationary. And then number three, technology. when technology improves, that makes things cheaper. That's also deflationary. So there are three huge deflationary pressures or headwinds against us. Now, this is good for us as consumers buying electronics that are less money. That's good. Energy, less money. And look, if China wants to drop their currency, if Japan wants to drop their currency, if Europe wants to drop their currency so we can buy cheaper Chinese, Japanese, and European goods, that's also good for us too when we go buy. The downside is it can create lower profit margins for publicly traded companies, and then people will not want to pay as much for that stock price, which will drive that price down. So it's really fascinating what's going on, and I will continue to watch kind of the price charts to kind of give you continue to give you the big picture of the markets. But so takeaway here, 30-day forecast, the stock market, it's got to decide. It's going to go retest most likely its August low. That's going to be a big decision-making point. There's lots of downward pressure on the market. Most sectors are also doing very badly, though the best sector is actually, and kind of interestingly, consumer discretions. The bond market, the big takeaway, interest rates are super cheap. Go buy a house. That's also my takeaway from housing. In addition, would be the best looking sector right now in the S&P is the housing sector, which is pretty amazing. Currencies, the big takeaway. Currencies have been manipulated from the beginning of time, probably for the last 5,000 years. It's no different what is going on today. There's a lot of currencies that are at some major pivot points all at the same time. So we'll keep a look at that. Ultimately, and this leads into commodities, ultimately I do think gold going up to $2,500 an ounce, $5,000 an ounce, will restabilize the silliness that all the currency, all the central banks are doing in the world. It's happened before, and I think it's going to happen again. The biggest takeaway from commodities, it's deflationary. Oil is falling, coffee's falling, precious metals are falling, and partially because of the zero interest rate policy that's come out of the central banks. Stick to your strategies. If you follow the market probability strategy, stick to it. It's smarter than all of us. Thank you so much for being in my world. Thank you for listening to this, and I look forward to connecting with you guys soon. Take care.